Hi guys, this is Dan from the Investment ABC, and in this video I want to explain how the Fed funds rate changed after the GFC in 2008. It is very important for you to understand how the mechanism of the Fed funds rate worked. The Fed funds rate determines how much liquidity is in the economy and therefore has an effect on asset prices like properties or stocks. The Fed funds rate is the interest rate banks are charging each other for lending money overnight. Banks have to hold a certain percent of the depositors' money in reserves in case the depositors demand their money back. First, I'm going to explain the Fed funds rate before the GFC with the help of a little drawing here. On the left side, we have the balance sheet of the Federal Reserve, and on the right side, we have the balance sheets of two banks, Bank A and Bank B. Every bank has assets and liabilities, and the Federal Reserve holds mainly securities as assets, a little bit of gold and foreign currencies. The liabilities are mainly dollars they created so far. The reserves hold for banks, commercial banks, and what is important is that if the commercial banks need some cash, they call up the Federal Reserve, and the Federal Reserve is shipping cash to their vaults. The banks, they don't get any interest on the reserves they hold with the Fed. So basically it is dead money. That's why they try to have as little as reserves as possible with the Federal Reserve. If we look at the right side, we can see the balance sheet of the banks, and here again on the left side are the assets, and on the right side are the liabilities. The banks are holding their reserves here, the green part, either in their own vault or with the Federal Reserve. And other assets, they could be, for example, securities or buildings or whatever. I didn't list them here because I wanted to make as simple as possible. Their liabilities are customer deposits, and the other liabilities I also didn't list it here because I want to make it simple. And in our example, Bank A has 10% reserve ratio. That means only 10% of the customer deposits here are really as reserves in the vault of Bank A. That means if all the customers want to withdraw their money, they can't because the bank has only 10% of the money. And Bank B has the 20% reserve ratio because maybe they're more conservative, or maybe they're more scared of a bank run. So Bank A has 10% reserve ratio and Bank B has 20% reserve ratio. If for some reason Bank A needs emergency funds, they can borrow money from either the Fed or another commercial bank, here in example Bank B. The interest rate which the Fed is providing is more than the interest rate from Bank B. The Fed's interest rate is also called discount rate, and the interest rate from another commercial bank is called Fed funds rate. The two banks can agree the interest rates freely, but it has to be higher than the discount rate of the Fed. Otherwise, Bank A would borrow from the Fed and not Bank B. Say in our example, the two banks agree on an interest rate of 5%. If the Fed is not happy with the 5% and they agree in the FOMC meetings that they should target a rate of 4%, what they can do is they can just print money and buy with the printed money. They can buy securities, short-term securities, also called T-bills, from the open market, and a mechanism called open market operations. So basically they print money, they go into the market, and then they buy short-term T-bills from investors like you and me, or other commercial banks. And what happens is that they swap the security, or the T-bill is going into the assets side here of the Federal Reserve, and the cash here, which was printed by the Federal Reserve, is going here into the bank of the investor. The investor is depositing the money here into his own bank account, And when he deposits it, what happens is that also the reserves are increasing by the same amount. But the reserve ratio is getting better. So in our case, the reserve ratio increased from 10% to 15% here whenever the investor deposited the new money. So the ratio, the overall ratio from reserves to customer deposits is getting better whenever new money is deposited into the bank. Like this, the reserves in the commercial banks are getting more, so that there is less need for reserves in the overall banking system. When there is more reserves available in the system, banks try to get rid of these reserves, so they loan it out to other banks for a lower interest rate than before. The Fed adjusts this process until they reach their target rate. Through this mechanism, they also adjust the money supply, because the more reserves the banks have, the more they can loan out the excess reserves through fractional reserve banking to the public. Fractional reserve banking is just a mechanism in which banks keep only a fraction of the reserves deposited by their customers and loan out the rest. Like that, there is always more money or more credit in the system than the banks have in their vaults. I will make a separate video about fractional reserve banking in the future, where I explain exactly how it functions. What is important now for this video is that the Fed is controlling the money supply and the interest rate with the same open market operations explained before. After the GFC in 2008, the Fed decreased the Fed funds rate to 0% and introduced quantitative easing. QE is a mechanism where the Fed creates money and buys any kind of assets other than T-bills from the market or commercial banks to inject liquidity into the economy and decrease longer-term interest rates. I will do another video where I explain in depth QE and compare it with quantitative tightening QT. So with the help of QE and 0% interest rates, the Fed flooded the commercial banks with a tsunami of reserves to curb the lending in the economy and to overcome the credit freeze. After QE, the balance sheet of the Fed increased by a huge margin, because all the printed money, because they bought with all the printed money securities, and whenever they print the money, also the liabilities increased. That's why the overall balance sheet increased. And all the fresh printed money went into the deposits of the commercial banks and increased their reserves. So they had that much reserves that they didn't have any incentive to borrow from other commercial banks. So the Fed funds rate almost went to zero, and the Fed was scared that the Fed funds rate might go negative. That is why they had to introduce new monetary tools. First, they gave 0.25% interest on reserve deposits, both the minimum amount required and also the excess reserves held with the Fed. The IOER is the interest on excess reserves, and the Fed provided 0.25% interest on the excess reserves. This IOER is setting a floor for the Fed funds rate, because banks, if they wanted to borrow money from another commercial bank, had to pay more interest than the interest the Fed gave for the reserve deposits. With the help of the interest rates, the banks had an incentive now to park their reserves in the Fed deposits if they wouldn't find any other investments in the markets, or if the risks were too high. With the help of these interest rates on reserve deposits, the Fed could drain liquidity now if they wanted to. So since the reserves are not in the vault of the commercial banks, and with the Fed, the commercial banks wouldn't loan it out to people so that the economy wouldn't overheat. The only problem was that the interest on reserve deposits was solely for commercial banks and not other entities like Fannie Mae or Freddie Mac or big hedge funds like BlackRock, for example. These entities could loan their reserve deposits to commercial banks for a lower rate than 0.25%, and the commercial banks could make a risk-free profit by depositing it with the Fed. Therefore, the Fed also introduced repurchase agreements, also called repos, and reverse purchase agreements, reverse repos. In a repo, banks are selling their securities to investors or the Fed overnight and make an agreement that they would buy the security back. These agreements can be seen effectively as loans, although the owner legally changed hands, and the interest rate for these repos are called the repo rate. For the party selling the security and agreeing to repurchase it in the future, it is a repo. For the party, on the other hand, of the transaction, buying the security and agreeing to sell in the future, it is a reverse purchase agreement, a reverse repo. A repo is used to raise short-term capital. The Federal Reserve enters into repurchase agreements to regulate the money supply and bank reserves. The Fed can also enter in repo agreements with other entities than commercial banks and provide them a repo rate of 0.25%, so that the other entities haven't an incentive to lend to commercial banks below the 0.25% interest rates the Fed provides for excess reserves. So this is basically how the Fed puts a floor to the Fed funds rate. And these are basically the new tools that the Fed is using after the GFC crisis. If you like this video, please hit the like button, subscribe, and share the video so let everyone know what's going on. Thanks guys, bye.